Hi, I'm Michael Martin. Thanks for being here. I'm a Los Angeles based commodities and equities trader who sometimes trades options. Today, I want to talk about what happens when you have a small account and what is the best way to grow a small account. I got news for you. It isn't scalping and it's not going to be day trading. The best way to do it is to buy bigger positions and hold them overnight over the weekend. Now, I know you're full of yeah buts, but I don't want to hear them because unless you've actually lived through, gaps overnight, you got nothing to say about it. You can only speak from experience, and unless you've experienced, you don't know how you feel about it. You're fearing things that you haven't experienced. How do I know? I've been there. I've been a broke ass bitch. And again, I wanted to make money that was going to change my life because my overhead at the time when I was coming out of school and I first went to Wall Street was large. I had at least 1,000 a month for rent. I had 1,000 a month going back to student loans, and I felt like I was working for everybody but me. And so I was very, very hyper aware of that. And this kind of stuff that went into the stuff I journaled about, because I kept track of like, okay, if I want to make big money, I have to have big dreams, but then I have to have my behavior parallel with my belief system, right? So come to think about it, again, I was lucky in that the expense of executing trades when I was younger was insanely difficult. I'd have to pay 25 cents minimum, and this is besides the bid ask spread, all right, to get long, and then it would cost me another 25 cents to get out. So you're looking at 50 cents commission, all right, round turn, never mind the bid ask spread, which on a good day, it might have been an eighth. It was probably at least a quarter. So luckily for me, the expenses were too high to try to move money very fast. So that was a good thing. That forced me to be highly, highly selective, to wait for the perfect setups. Yes, I did miss a few. I probably missed a lot over the years, but I had to wait for those asymmetric situations. And then what I did was, and again, you'll have to figure out if this is good for you, if you speak with your financial advisor, because the way I traded was very, very aggressive. But to me, trading aggressive wasn't greed. It was me making a statement and acting intentionally and actually making a bet on myself, right? That's how I differentiated it. So I would say take my 5K and I'd break it up four ways, So I'd have, say, 1250, I guess, is the first quarter, put that to work. If I started making money, I would add and buy more. So then I'd have half my money in one particular name. But then when you think about it, if that particular name, say it's a $10 stock and it goes to 11, right? And I've just made 10%, that 10% is 5% of my account balance because I was already thinking about I needed 50 to 100% rate of return for this to make sense for me, right? After commissions. So I wasn't going to make that money by whipping capital around and keeping my money in motion. That's a theory out there, but it's not one that's foolproof, and it's not the only theory out there. You can make a lot of money by buying stuff and keeping it. Risk is good. If you're in strongly trending markets, those are what I would call good risks. Trying to find, names or trade around patterns where there's nothing significant going on in terms of highs or lows, is more random, more noise. And I refute the idea that you can kind of predict how much you could lose in 2 seconds. In 35 years, I've seen markets jump insanely fast while I was in trades, while I was sitting on top of the computer. And so this whole, you can act like a market maker thing, it might make sense if you were from that type of environment and you learn those skills, but without any type of training, you're a fish out of water, right? So then if I could stick for the name to grow, say 20%, $10 stock goes to $12 or $20 stock goes to $24, which is kind of reasonable, right? It's not that unreasonable to think that you could see that over a couple of weeks. Now you're up 20% on $2,500 and your account balance is up 10%. So I knew about diversification and I knew that I took bigger risks. I also knew that if you looked at how diversification reduces risks, those risks are what the unsystematic risk. The market risk is always going to be there. And having studied finance and economics at a pretty good school, I knew what the chart looked like. and I knew, I think the number was six, right? After six names in your portfolio, the incremental benefit from further diversification is very, very small. So there's an optimum number for you. And I know I'm not the only person. I certainly didn't invent this. I kind of came through it just through lots of trial and error. In that, if you can think about taking your money and breaking it into four or five parts, that's really all you need. And you don't even need to use margin, right? You should only use margin, since we're on the subject, when you know you can make money with cash. If you can't, if you're not profitable just trading cash on cash, then don't borrow money. Don't worry about four times your capital in day trading buying power. It's not going to help you trade better. You should be able to master your skill set risking $50 and learn your craft. Then you can scale. So I really just knew how to handle the risks. I knew where to put my stops. I had a keen eye for that kind of stuff. I certainly made tons of mistakes, but my goal was to accelerate the growth and make monster gains, which is actually easier to do with a smaller account. Case in point, you got 10K, you could turn that into 50K. I think a lot easier than you could take 10 million and turn it into 50 million. There's people who probably debate me. Yeah, but Mike, I got this money from like as a bequest. My uncle left me the money, so I'm very personally attached to it. Okay, well, good on your uncle for leaving you money, or whoever the parent or the relative was. But what do you think they would want you to do with that money? Do they want you trading at all? Because if you're going to trade it, you should trade it. If you're not going to trade it, then put it into the bank and buy treasuries or something like that. But don't take financial risk then, right? So I knew exactly what I want my money to do for me. And making, like I said, but in other episodes, making 12%, which is what the total return on the S&P was at the time, wasn't going to mean anything to me. 401k stuff, yes, that's fine, but 5,000 going to 5,600 at the end of the year, it wasn't going to move the needle when I had overhead that was going to knock out the Bronx Zoo at the time. So, two, keep in mind, I was also trading commodity futures. Now, the futures margins, the E-mini didn't exist at the time. It was still the Big Daddy, which was $500 a point with $40,000 worth of margin. So it was an institutional product. You couldn't trade it. But everything, gold was like $250 the ounce. Corn was $2, maybe $150. Everything was lower, which means when it had lower volatility as a percentage of its base price. So the margins were lower. So I could look and say, okay, find me the best stock, be highly selective, start with $1,250 investment. Didn't matter if it was a round lot or not, because I was looking for percentage growth. If it's working, buy more of the same thing, build into a position. I know where to put my stop. I can reinvest my gains into my stop and know where to get out, break even, right? I knew what was in it for me. But then the futures margin, I still had $2,500 there that I could use to deploy. Now, today they have, what is the margin during the day versus what's it overnight? I don't know all that stuff, so I can't speak to it. I don't pay attention to it. But there's still a way to do it with the right instrument. You might not be able to do it with your favorite instrument, but you might be able to find another instrument where you can. And that's where you have to be promiscuous and very open-minded in your thinking, because the goal is to grow your money. Right? It's not to be the biggest orange juice trader on the face of the earth, right? That might be incidental. If you could do it that way, great. It's very thinly traded, but you could go knock yourself out. And so, same thing with like anything of the cryptos, like that might be the foray that got you excited about trading, but ultimately you get paid for taking risk. And if you're in good risks, those good risks are going to reward you overnight and over the weekend. And that was the key to my success. It wasn't making 50 cents in a day, because by the time all the commissions and everything were done, there was no money in it at the end of the day. So I would advocate starting small. Why? Well, by putting only $12.50 to work, when the thing didn't work against me, I was able to get out quickly. I think if you're going to plunge and put on your optimal size all at once, there could be ego there for sure, but you're also opening yourself up to bad luck and bad timing. And I didn't want to lose money from bad luck and bad timing. I wanted to have good analysis and good luck and good timing. So I waited till I thought I could get all of those three to line up. And based on yesterday's, episode, you can go back and watch Mastering, your own trader psychology. This is the kind of stuff that I looked at. Like, where have I seen good timing before from my past behavior? What was my thought process that I used to put myself in the right place at the right time? You see what I'm saying? So it goes against the grain. Everyone feels there's some kind of boogeyman overnight and you could lose everything. If you're afraid of doing that, in my humble opinion, you shouldn't be trading, right? Because if you're going to sit around and make nickels and dimes, it's going to take you forever to grow your money. So yes, if you want the emotional wins, keep doing what you're doing. I didn't want to make peanuts. It wasn't going to, for the time that I had to put into it, it wasn't worth the time that I was getting out of it. And even then, minimum wage was at whatever, $4 or $5 an hour. So I didn't want minimum wage money for doing this type of job. I knew that I had to grow my money and accelerate it and make geometric returns, something that I'm very, very aware of. I know how to do it. And that was always my mindset and my approach. That was my overall ethos, was how do I find asymmetric returns and how can I make more and more money from doing less work, right? Pareto efficiency. So when you think about this for yourself, really challenge the way you think, like who taught you what to think and why do you believe it? If you have an experience, because that's faith, right? What are we but for our faith? Why do you have faith in these statements when you've never experienced it yourself? How do you know that every overnight loss is going to be crippling or put you out of business? Because that's just not the case. That's not my experience. Yes, there have been times, probably like I was in Mad Cow. I was long feeder cattle when Mad Cow hit the tape. It was locked limit down 5 days in a row. I couldn't get out of the position. But I had position sized properly so that, yeah, it hurt me. But what does that mean financially? Right? A couple of percentage points, 3%, it's not going to kill you. It thickens your skin. It helps you understand the nature of how you take risk. I'm not saying go out and roll the dice. You have to have a process with which you're compatible, for sure. It's not dart throwing, despite what the Wall Street Journal thinks they can do with your money. Nobody with any type of even below average intelligence would run money that way. So it's kind of cute from an entertainment standpoint, but it's pretty stupid from a practical standpoint. And that's the way I did it. If you want to get used to scalping, that's great. But I wouldn't, to me, it's like if you're going to trade, you might as well put on your full risk unit. I don't want to, if I'm normally trading 100 contracts, why do I want to put on 10? What's the joy in that? Is that for the emotional win? I don't believe in doing counter trend stuff. I don't fade bull moves in uptrend markets trying to be cute with stuff. I don't. I don't think you should either. I know there are people who do it, but to me, I'd rather wait for the trend and just make. There's no easy money, but with the wind at your back, you can make a lot of money. I made money when I started out, and I didn't even fully understand why I was making the money I was making. And I had a really good education. I just had a knack for putting myself in the right place at the right time. And as my good friend Jared Dillian would tell you, I always had a knack of knowing when to leave the party before the first beer bottle started getting smashed against the wall. And so maybe I'm lucky in that I was born with good timing, but I wouldn't have known that unless I was willing to take the risks. And taking good financial risks, I think, are going to make you feel uncomfortable. They're going to make you feel uncomfortable, and getting comfortable being uncomfortable is probably a good thing. I felt it through all the stages of my life, right? I was over 50 years old walking onto the mats in jiu-jitsu as a white belt. I didn't know anything. I didn't know anything. It was really scary. Turned out to be a really great decision for me. But at the beginning, it certainly didn't feel that way. That's for damn sure. So this is how I want you to start to think about things is don't do this for peanuts, because you're always going to have a chance for loss. There's always going to be something that could happen, even if it's during the day, even if you're looking at 1-minute bars, even if you have 8 monitors around you, you could still always lose more money than you ever dreamed of. Being on top of the screen with a headset on and a fast gamer's mouse gives you a false sense of security. So find good risks. Keep those risks in your portfolio. The market will tell you when the move is over, right? They're called reversals. It's very easy to do. Any more advice, you can go back and watch yesterday's episode on trader psychology or how I'm changing my own daily morning routine thanks to Andrew Huberman's episode.